Hi everyone, today I'm going to spend a little bit time to talk about house savings account, also known as HSA. This is a great benefit that a lot of people don't even know about, and there's an opportunity that you can save your tax bill and plan for the future house expenses. Before we dive in, we got our quick disclaimer to share and moving right along. First, let's look at the tax advantage feature. This graph is the comparison of the other two tax deferral tools. For a traditional IRA or 401k, your contribution is tax deductible, but when you use the money, you have to pay income tax. Roth IRA or 401k, your contribution is after tax, but when you use the money, it's tax-free, which means all the growth is tax-free. Comparing to the other two, HSA has even better benefit, where you can get your tax deductible today and let your money grow. When you use the money for the qualified medical expenses, it's tax-free. That's a great tool, but you have to have the high deductible health plan in order to contribute to HSA. High deductible plan means higher deductible, higher out-of-pocket cost, and cheaper premium than PPO. PPO is the Preferred Provider Organization, a traditional group plan. If you choose the high deductible plan, your employer might contribute some money to your HSA each year. For federal limit in 2021, the total contribution that you and your employer can make is $3,600 for single and $7,200 for family. You can max this out by April 15th, 2022. If you have medical expenses, you can definitely spend it from your HSA account. However, if you can cover the cost from your other available sources and let the HSA money grow, you could end up with even larger tax-free account for spending on medical expenses down the road. Let's see an example here. Assuming you're 35 years old, assuming annualized investment return is 7%. Each year, you invest $3,600 in your HSA account. After 30 years, your accounts will be around $364,000. Comparing to if you don't invest it at all, that will be $108,000. That's a huge difference. Obviously, everyone has different situation. For me, I like to invest the money that I don't need in the HSA investment account and leave some cash for short-term medical needs. Let's see another example here. The same assumption, 35 years old, 7% annualized return. Each year, if you invest $2,600 in your HSA investment account and leave $1,000 cash for spending. After 30 years, your HSA investment accounts will be around $263,000. See the side with $30,000 cash for spending. That's still a lot of money. Now let's look at other considerations. If you use your HSA money on non-medical expenses, you have to pay income tax as well as 10% penalty. However, if you reach the age 65, you only need to pay income tax. There is no penalty. This feature is very similar to IRA. Also, you can always reimburse yourself from your HSA accounts anytime on the medical expenses that you have paid from other sources. For example, you just started savings and you have $10,000 medical bill. You can spend it from your bank account. But remember, keep your receipt. You continue contributing and investing in your HSA account and have a lot of assets over time. After 5 years, you decided to reimburse yourself of this $10,000. You can transfer $10,000 from your HSA account to your bank account and get income tax deduction on this $10,000 when you file your tax return. But remember, when you file your tax return, you need a receipt that you kept 5 years ago. My name is Miao Yu from Avier Wealth Advisors. I'm on LinkedIn. Please feel free to reach out to us if you have any questions. If you like this video, please click like and subscribe to our YouTube channel. Thank you. Have a great day. Bye.